Over the past few years, the Philippine peso has experienced a steady decline, especially compared to other currencies in the ASEAN region. Many news outlets have reported on this, and if you took a closer look, these very news outlets have stated many setbacks against the Philippine economy due to a weak peso. Factually, it does have its own issues. It impacts the country's importation from goods abroad to even international tourism, making it harder to travel overseas due to a weak peso. For reference, the Philippine peso in early 2020 was around 50 pesos to $1. By October of 2022, it rose to over 59 pesos to a dollar. As of the time of writing, it hovers around 56 pesos, but seemingly trying to breach that 57 pesos to a dollar. This has led many observers and analysts to state that the peso is indeed weak. But what we want to answer today is just why is the peso so weak? Is it a result of poor economic policies, or is it influenced more by international market conditions? And another question that looms large: should the government intervene to make it stronger? Should the Philippine government do what it can to put the peso back to 50 pesos to a dollar? Secondly, we must also ask why any of these matter. The strength of a country's currency, after all, is quite like a report card for its economy. If the currency is strong, it usually means the economy is doing well. But if it's weak, people start to worry. And this worry isn't just limited to bankers and economists. It trickles down to the everyday lives of ordinary people. So to understand further, let us first talk about the reasons why the Philippine peso is so weak. First, let's talk about imports. Whenever the Philippines imports more than it exports, it needs more foreign currencies. That means it has to trade its own currency, the peso, for other currencies like the US dollar. The greater the demand for the dollar, the weaker the peso becomes. The country's growing demand for imports, from gadgets to oil, has contributed to the peso's decline. Another factor we can't ignore is inflation. Higher inflation rates mean your money's value decreases, and the same amount of money buys you less than before. This has a direct impact on the peso. When inflation is high, confidence in the currency usually drops, leading to a weaker peso. Global factors also play a part. For instance, the strength of the US dollar affects currencies worldwide, including the peso. It's not always that the peso is weak. Sometimes the dollar is just strong. Lastly, let's not forget government policies. The central bank's monetary policies, such as interest rates, have a say in how strong or weak the peso is. And it's not just about economics. Political stability also affects investor confidence, which in turn impacts the currency. But we'll discuss these government policies more in detail later. But for now, one thing that you crucially need to understand is that there are so many factors that determine why the peso's dropping. Of course, some other factors like the US dollar strengthening plays a larger role, but one should not dismiss all the smaller ones. Now that we've talked about why the peso is weak, let's then dive into what that means for the Philippine economy. First off, remittances. A lot of Filipinos work abroad and send money back home. When the peso is weak, these remittances translate to more pesos for families here. That's a plus. This extra money often goes into everyday expenses and sometimes even savings or investments. But do take note that in turn, a weaker peso means imported goods become more expensive, which also directly impacts the entire economy, especially those relying on imported goods. Secondly, higher costs of imports lead to inflation. Prices go up, and the same amount of money now buys you less. For a country where many people are living close to the poverty line, this can be a big deal. Inflation hits those with fixed or low incomes the hardest. Then there's the matter of foreign debt. A lot of the Philippines' debt is in foreign currency. When the peso is weak, it costs more to pay back that debt. This can put a strain on the national budget, leaving less money for public services like healthcare, education, and infrastructure. On the flip side, a weaker peso can be good for tourism and the outsourcing industry. Tourists find that their money goes further, which could attract more visitors. Similarly, for foreign companies looking to outsource, labor costs in the Philippines become comparatively cheaper, making it more attractive as an outsourcing destination. Let's move on and discuss one more important concept: the government. The government has a lot of say in the Philippine peso. They can do various interventions, such as adjusting interest rates or directly buying and selling currency to influence the peso. One basic way for them to increase the strength of the peso is to increase interest rates. This would then attract foreign investments, as investors seek higher return on Philippine assets. In fact, we've seen this occur across the entire world. For instance, the reason why the US dollar is so strong right now is because the US Federal Reserves have been hiking interest rates left and right. This has led to the US dollar to become very strong. The Philippine Central Bank has also been raising interest rates, but its effects are not as strong as what the Federal Reserve can do. One of the questions asked is, if increasing the interest rate was the answer, why don't the Philippine Central Bank just hike as much as they can to make the peso stronger? Well, here's the problem. Higher interest rates can also slow down economic activity. Loans become more expensive, so people and businesses might cut back on borrowing. Less borrowing means less spending, and that can slow down the economy. Now, another way the government could make the peso stronger is by buying pesos and selling foreign currency. This increases demand for the peso and supplies more foreign currency, aiming to push the peso's value up. But this is also a risky move. If the government uses up too much of its foreign reserves, it could create more problems down the line. Further, let's also not forget that a strong peso has its drawbacks as well. It would make exports more expensive for other countries, possibly leading to a drop in demand for Philippine products abroad. That's not great for businesses here that rely on exports. Also, those remittances we talked about earlier, a stronger peso would mean they'd be worth less in peso terms, affecting families that depend on them. So, is a strong peso the answer? It's complicated. Strengthening the peso might ease inflation and make imports cheaper, but it could also slow down economic growth and hurt sectors like exports and remittances. The key here is balance. The government has to carefully weigh the pros and cons and aim for a peso value that's not too weak but not too strong either. Furthermore, to avoid the issues today and aim for a better future, what the government should also do is to diversify exports. Right now, the Philippines relies heavily on a few sectors, like electronics and services like call centers. If there's a global downturn in these industries, the peso and the economy take a hit. The country needs to explore other sectors and markets. This will make the economy more resilient and can have a positive effect on the peso. Secondly, there's an issue in policy consistency. Businesses, both local and foreign, like to know what they're getting into. If the government keeps changing its policies, it creates uncertainty, and uncertainty is a turn-off for investment. Consistent, sensible policies can create an environment where businesses feel comfortable investing, and this can lead to a stronger peso. Last but not least, managing debt responsibly. The government needs money to operate and invest in projects that can benefit the country. But borrowing too much can be dangerous. High debt levels can make investors nervous, leading them to pull their money out of the country, which can weaken the peso. So, responsible debt management is crucial for maintaining confidence in the economy and, by extension, the peso. In conclusion, there's no quick fix for a weak peso. It requires a multifaceted approach that looks at both short-term gains and long-term stability. Whether the peso should be strong or weak is a complex question with no easy answer. But with thoughtful strategy and responsible management, the government can navigate this challenging issue. Thank you for joining us on this deep dive into the Philippine peso. But anyway, do let us know what you think. Thanks for watching.